Hello, welcome everyone to the eToro Popular Investor Quarterly Forum. I'm really lucky to be joined by some really great guests from around the world as we talk about different subjects regarding the economy and the stock market and what's happening at the moment. So just before we get started, I just want to let everybody know that the views of the panelists are not financial advice, and we are not employees directly of eToro. So let's get started. And I'd like to introduce this panel. So I will start off with our special guests that are new to the panel today. So I would like to introduce Robert Reynolds to start with. Rob, could you please introduce yourself?
Thanks, Stephen. My name is Robert, as Stephen mentioned. I've got a background in finance. Been investing for about 13 years with more of a focus on value, but conscious of the macro environment. And as of right now, you guys can find me on eToro with the username Robert Merck.
Thanks very much, Rob. And over to you, Hugo, if you'd like to introduce yourself.
Hey, thanks for inviting me. My background is in financial services mostly. I've been working in investment banking, private equity, and corporate development for 10 years before making the move to eToro full-time. So I invest mostly in equities with a long-term focus across really a pretty wide range of industries.
Okay, thanks Hugo. And over to Simone, can you please introduce yourself?
Sure. Hello, everybody. I'm a long-term investor in eToro. I started trading in 2019, and since then my portfolio was always focused on biotech and IT stocks mostly. Over the time, it became a bit more diversified, but this is still my focus. I come from a background in computer science and medical science, and currently I'm working as a researcher in bioinformatics and immuno-oncology. And yeah, that's it. Thank you.
All right, thank you, Simeon. And over to Zach, please.
Hey, I'm Zach. I'm the fund manager, Zach. Been trading on eToro for about coming to 7 years. It's been a fun ride. I do multi-strat, so I invest in everything that I can buy. Yeah, anything that looks good, I'll just buy it.
Good. Sounds good. Thanks, Zach. And I'll just introduce myself as well very briefly. My name's Stephen, and my username on eToro is 𝗏𝗟84. I'm a multi-strategy investor, invest in a number of different asset classes, and I have been an investor for about 15 years, investing in different asset classes. Yeah. So that's everybody introduced. So now we will run into a number of different topics, and we're going to talk about some of the hot topics that are happening at the moment in the markets. And I thought we'd start off by summarizing what happened in Q1 2023. I think the panel will agree that it was a lot better Q1 2023 than it was the end of 2022. So that gave everybody a bit more breathing space. I'm sure everybody's very happy about that. But we just want to quickly run through some of the key things that happened in the markets in the last quarter. So can I start off with Hugo? Any key factors that you think were very key in the markets performing well in the first quarter of 2023?
Sure. It's been really bumpy, especially because surface where you had a lot of divergence between various sectors. I think the main thing in Q1 was started with expectations of a soft landing, strong economy, inflation in check, and then kind of inflation and employment was a bit hotter than expected. So the market bounced around a little bit. I think what I'd highlight is one, artificial intelligence. I think that just really came as a top topic, and I think we're just starting to scratch the surface of the implication that it has. And two, of course, the banking crisis that shook markets in March, and I think had a positive impact on tech, interestingly, and a lot less positive on cyclical sectors. Good Q1 overall, but under the surface, there's a lot of nuances. And that's, I think, where investors can add a lot of value.
Do you think that the Fed and interest rates and a lot of rumors about interest rates that they could potentially start to halt those interest rates in the future, and they have slowed down those interest rate hikes, What's your view? Do you think that they could continue to increase those rates, or do you think that they might almost be done?
I think they're almost done. I think the banking crisis put a ceiling on rates. They showed the Fed and investors really that there's a sort of like a maximum where you can go. And if you go beyond that, then you'll break the system. So that was a bit of a blessing in disguise, to be honest. And now you're seeing inflation measures starting to really soften. The employment market's also starting to soften over the last month or two. And so I think that gives a license to the Fed to pause pretty soon. One more hike at the next meeting, but then after that, probably done.
Okay, thank you, Hugo. And Rob, any key things that happened in Q1 that you want to bring up that gave some good, strong tailwinds for the market?
Look, I'm a big believer that I think liquidity drives asset prices. And if you look at the economy last year, it was actually stronger than what it was in Q1, but we actually seen a recovery in asset prices. And if you go back to October, November, we had max sort of tightness. And then since then, you've seen the overnight repurchase agreement, which sucks liquidity out of the system. That kind of peaked out, and we started to see the TGA drain a little bit further. So the government's balance sheet, they started to spend more of the cash that they had raised from tax receipts last year. And all that liquidity so we reached max tightness in October, November last year, and liquidity's actually started to ease. And you can see that fairly reflected in real time in the price of Bitcoin, which is really just a barometer of liquidity. As that liquidity is being flowing into the market, Bitcoin go from a low of 15,000 up to 30,000 inside a couple of months. And I think Q1 is the beginning of possibly a slow growth environment that could lead into a sort of shallow recession. And I say a shallow recession because despite popular belief, I'll quote Jamie Dimon rather than say it myself, but consumers and businesses are in good shape and there's still a buffer of cash left there if lending started to slow down. So we're in a weird situation where there's probably too much cash in the system, and you've got a problem where there's been a massive wealth transfer in 2020 where the government increased their debt levels and pushed all that cash onto household balance sheets. And so you have this weird balance in the market where consumers and businesses are fine. US government's way over levered, and raising interest rates is not a good environment when you're planning on doing $1.5 trillion deficits. And then raising rates too quick ultimately impacts the banking sector due to a funding crisis. And so all of these different variables came together in Q1, whereas Hugo said, I think you get to a point where, you know, we've reached the ceiling in interest rates. You look at the inversion of the curve 3 months to 10 years out, there's no way banks can lend. So you have to start cutting interest rates, otherwise lending collapses and the economy falls. And that has knock-on effects. It has knock-on effects because the government's tax receipts, 56% is income tax. So when the Fed say they want unemployment of 4.6 to 4.8%, the consequence is a government doing $1.5 trillion in deficit spending, plus their income goes down. And so I think where we are, like just to summarize that a little bit, I mean, from a macro perspective, I think the reason why Q1 was better, even though we're seeing a slowdown, is just entirely driven by liquidity. And that's what my view is. And I think that's probably going to continue. The economy continues to weaken, but equities recover. And I think it's going to be a kind of harsh reality in a market where people are quite confused. That's what my view is as of right now.
Yeah. And Rob, do you think that the Fed can achieve a kind of soft landing? And do you think that they may get the inflation rate down at least close to their target of 2%?
So if you go back to 1980, just this is what everyone's reference point is. Inflation gets up to 10, 12%, whatever it was. It didn't drop from 1980. It didn't get down to 2% until 2003. And it wasn't Paul Volcker that actually stumped inflation. It was actually an oversaturation of labor. And you can see that in wage growth. You had 3 spikes in inflation, and every single time interest rates were pushed higher. And so when you look at what rising interest rates done, it kills demand. But it doesn't kill supply chain issues. And supply chain issues includes labor market. So you have a problem where the participation rate's gone from 66% down to 62%. 4% of the entire US population is out of the labor market since 2008. That's 12 million workers that are no longer in the workforce. So you have raising wage growth, and people have been telling me since God knows how long that automation is going to replace workers. And the reality is Target are raising minimum wages to $14. Amazon are raising it to $15. High school degree, like people with no degrees have experienced, according to the Atlanta Fed data, they've experienced higher wage growth than anyone that had a degree. And so we're at a point where I guess my view would be, can they achieve a soft landing? It depends on from what side of the fence you stand. The higher interest rates go, you're going to need to see either austerity from the US government, or they're going to default on their debt. And so there's a lot of chain reactions. It's very difficult to really put your finger on it, but I guess it's binary in my view, where you raise interest rates, the government continues to struggle with funding, it goes into austerity, but then there's a negative wealth effect. Then there's a problem with tax income receipts. The economy gets smaller. The US government can't afford its discretionary spending, which is military. There's loads of stuff that I would say, if they continue to raise rates, would have negative consequences. Funding is going to collapse. The inversion of the 3-month versus the 10-year is so wide, I think it's 120 basis points, that if you understand how banks lend money, they borrow on the short end deposits and they lend on the long end, that spread is negative. They're not going to make any money. And again, as Jamie Dimon said, it's going to be lenders pulling back funding. So I think that where rates are going to be cut, as the market suggests, probably June into mid-2024, that's what's priced into the curve. If you see June all the way into mid-2024, late 2024, yeah, I think you get a soft landing, because consumers and businesses still have a buffer. Net cash positions for households is between $600 and $800 billion. In the global financial crisis, it was a deficit of $5 trillion, $5.4 trillion. So it's a really different market. So I think there could be a soft recession for sure. I don't see a deep recession until we get positive cash balances negative. So we'll see. So yeah, that's what my primary view is.
Okay, thanks, Rob. And I think they've spent the whole of 2022 trying to reduce their balance sheet, the Fed have. And just in 2023 so far, they've had to implement that emergency initiative for the banks, that emergency program to help fund the liquidity of banks, etc. So that's already really brought in a lot more liquidity back into the market already. And they've actually lost their way on reducing the balance sheet because of what happened with the banks. Whilst we're talking about the banks, 𝗥, what's your view on the banking crisis that happened over the last couple of months? Do you think it was isolated to a few banks which had bad treasury management, or do you think it could spill out into a much wider banking crisis which could have an effect on the economy? What's your views?
Interesting. I think none of these views are my own. I think Robert talked about it just now. We were talking about different sectors of the economy or different parts of the economy. Different people of the income, levels of income are facing this inflation differently. So basically, people from Facebook and Meta and all that are losing their jobs, and people who are the lower end, they're getting more pay. So what happened in especially Silicon Valley Bank, if you think about it, most of its customer base was in Silicon Valley. So it didn't take much for, I think it was like 13% of deposit outflows for them to be a complete collapse of the bank itself. And it's just having too much of a concentrated base. I personally think it's isolated. I think what the Fed has come up with, its kind of repo facility, which just allows them to post any collateral and just take no haircut and get liquidity. I think that kind of solves it, at least for the time being. But I think Stephen shared with me this fund outflows basically into money market funds. So people are not depositing money into banks anymore. They're buying bonds instead, which makes a lot of sense because you take less credit risk and you get more interest. So that's a fascinating mechanism. But I don't know. I think it'll be tough for banks to make money going forward. But I think the worst is over. I don't think there'll be an outright collapse of everything.
Yeah, I think now that the Fed almost guaranteed backstopping customers' deposits, I think that's much less likely now for there to be a run on those banks. But one of the main issues is that a lot of people are leaving some of the regional banks, the smaller regional banks in the US, and starting to withdraw their money and going to much larger banks. And I'm guessing that is mainly because they think they're much more likely, if there's a wider banking crisis, that they're likely to bail out the larger banks rather than the regional banks. Because I think the FDIC insurance is $250,000 minimum, but I don't know if I have heard that they are planning to maybe increase that insurance limit. Zach, do you want to just briefly go over one of your latest in the banks and why you bought that stock?
Bought it and then sold it. I bought 𝗘, which is 𝗘će Corp, which is based in Florida, so it's named after Florida Keys. That was a smaller bank, but looking at just their kind of customer base, it was pretty diversified, so I thought it looked better. And then if you look at how much they're lending out to, mostly in different types of properties, it's also, again, not concentrated. And a lot of it's depositor based with FDIC insured, so unlikely to run on them. So I thought that was a good buy. But I sold it mainly because I think it's going to be difficult for banks to start lending anymore. And I think that's going to be tough on commercial property. And I think that's going to lead to some issues in the commercial property. So as much as I love the stock that Robert, to me, BLDR, I sold that because I am worried about property.
Yeah, but you moved over to European banking instead. You mentioned to me that you thought that European banks were potentially going to be a lot stronger than US banks. What was your reasoning behind that?
Yeah, this one's a fun one. So we said a lot of deposit outflows is because like people are taking their money out of banks and buying bonds. So, you know, in US, right, you can buy the TLT and things like that. I have 4 different European panelists on this panel. Can any one of you name me a Euro bond ETF?
Euro bond ETF.
I can't, but like bonds for the last decade, for most of it, 1/3 of all European bonds were negative yielding. So I can't imagine there was going to be a huge amount. Like there was a lot of regulatory demands for specific institution to hold European bonds, but I don't know if there was a lot of appetite for the past decade anyway. There could be moving forward. A German bond, I think, hit 3%, did it? I'm not sure. But I can't imagine there's a huge amount of appetite. Could be wrong.
I mean, when you see how Cyprus, Greece got bankrupt, and then the issues in Portugal, Spain, Italy, and then you see the yields on those bonds at 2-3% max, it doesn't make sense.
And those bail-ins that were pushed in Cyprus was by Madame Lagarde when she was at the IMF, and now she's head of the ECB. So we've got a pretty ruthless head of the ECB here, and I'm not sure. Like that's what led me into Bitcoin, which we'll talk about later. But yeah, she's got a history for sure.
Yeah.
The point in saying that is I don't think any liquidity is going to flow out of like retail into ETFs and bonds and stuff like that. So in Europe, it's just difficult. So I bought Societe Generale because I looked at it and then, okay, they're not going to go anywhere. Where can they go? Societe Generale giving you like 7% yield. And I think it's going to grow this year. So it's a pretty safe bet.
Yeah.
And yeah, by the way, it puked when SVB failed. So it was selling at discount. So I just bought it. I think it's a good buy. We'll see how it goes.
Yeah, they definitely took a hit, the banks, during that last month or two. Okay, and Moni, how are you thinking about the markets at the moment, and how do you think about this recovery so far in 2023? And do you think it's more likely that we're going to have a U-shaped recovery or more of a kind of a V-shaped recovery?
Okay, I would like to take a little bit of a step back.
Okay.
I want to shift the conversation from macroeconomics to more specific things that happen that were more interested for my market, for my portfolio. I agree with most of the things you guys mentioned. I don't have a strong financial background as you do, to be honest. So I don't want to comment too much about what is going to Fed to be doing over the next 6 months. You guys know probably a lot better than me. But what happened from my point of view in the markets is that there were a few interesting drivers, especially in tech. Everybody heard about ChatGPT, for instance, and that awareness of AI and its potential really drives tech stocks a lot. I think Rob mentions before that growth stocks, tech stock, for instance, have been like favored by these macroeconomic conditions, but that's part of the story. The other part is actually technology is really improving, and it's improving very fast. Here's an example of that. And it's revolutionizing the many segments of the market. Just for example, the earnings reported by AMD and NVIDIA showed a very strong performance of data service GPU, which are the one used to actually train this kind of neural network algorithms. So my portfolio mostly benefits from that. I cannot know how to quantify how much of my performance came from macroeconomics, how much came from this kind of events. So ChatGPT is an example. So that's something to keep in mind, because that is sure low interest rates environments drive innovation. But even if we won't end up in a lower interest environment, we can still have innovation. ChatGPT happened in the moments where interest rates were like rising very fast. Even in that conditions, we can still see improvements that can lead to better stock prices as well. So to go back to your original question about U-shapes, V-shapes recovery, how it's gonna be, it really depends on macroeconomics, probably on the short term, but on the long term, these technologies will likely play the most important role.
And what are your views, Simone, on the kind of future of artificial intelligence, and how far could it potentially go? For example, cutting jobs. Is there elements of it that are potentially dangerous as well for the future? Anything you want to add to that?
I'm not going to be so alarmistic as Elon Musk. So I think there is a risk that can be dangerous for us, but I wouldn't say it's definitively going to happen. It's more like we need to be careful, but we should not limit innovations because of that risk. So we need to continue developing these technologies, keeping in mind that to not do anything stupid with that. How it's going to affect our work? I don't think it's going to substitute works. It's really going to speed up work. You still need to know what to do with GPT, for instance, or whatever AI you are going to have. So I've been reading a lot of people saying, I asked ChatGPT to code this software for me, and they did it, and it's working. I've tried to use it in my coding, and really, I don't think you can code anything with ChatGPT if you don't know how to code in the first instance. So you need to have the basic understanding of software engineering to actually do that. And it's probably the case for many other jobs. So we still need to have people that knows the job, and then they can use this kind of technologies to make it faster.
Yeah.
But for now, that is the more likely evolution of what is going to happen. Yeah. So there may be a few jobs that it would be automated, but for the vast majority of them, I think your job will be safe. So don't worry.
I think we're still in the quite early innings of artificial intelligence. I think that there's a lot more that they can do around it, but I think that they're going to have to catch up in terms of regulations and see how they want to safeguard it, because there could be some potential misuse if it's developed without regulations around it. Anyone on this panel actually use ChatGPT or anything AI for any practical uses? Anyone using it?
Just on what Simone had mentioned about being a domain expert, I've seen exactly the same. Some of the stuff is really useful, but if you're a domain expert, you can spot that there's certain things that are not really correct. So I can see ChatGPT increasing productivity for sure, but as of right now, I still think you need to be a domain expert. And it's shocking to see ChatGPT write a paragraph, and when you read it, it sounds so confident, like you're speaking to a guy at the bar having a couple of pints. He's making all this stuff up because he's very confident. And you're reading this confidence from ChatGPT, and you know that it's wrong. Like not all of it, just anomalies. But I agree with what Simone had said, is for domain experts, it's going to be fantastic. But I think a lot of people are going to start using it for stuff that's out of their expertise. And I think it's probably going to increase the amount of confusion in the near term before we actually streamline it, but we'll see.
Yeah, because you can actually say to ChatGPT, can you give me a positive argument about this area? And can you give me a negative argument about this specific topic? So without the actual knowledge behind it, you're going to become unstuck, aren't you?
Yeah, I've also seen people input wrong information and ChatGPT use that as, even though it knows the right answer because you're telling your prompt or whatever, the information you give it as a prompt, it gives you a response that's using the incorrect information. So I've seen a lot of people tested in that manner. So I guess it really comes down to the quality of the prompt as well, and whether you're a domain expert. I don't know, that's what my view is.
Yeah.
Can I add one philosophical statement on ChatGPT? It's not that important the answer. The important thing is the question you ask. So you need to know which question to ask first.
Yeah, it's definitely a very interesting technology. It'll be interesting to see how it's incorporated into everyday life, because it's not just text, right? They can do artificial images, all sorts of different stuff. So yeah, let's see how that progresses. Okay. Actually, Simone, I just wanted to ask you what else got you on the call this quarter. I wanted to ask you, has there been any effects in terms of those higher interest rates, etc.? Has there been any effects on the pharmaceutical industry or the medical industry?
Yes, yeah. The fact that we have seen that already years ago, like probably we start to see the effect of raising interest rates already in end of 2021 or mid of 2021, actually already February, when they start to say inflation's going up, what Fed is going to do. And Fed at that point was still saying, oh no, we are not going to raise interest rates. At that time, the biotech market was already being impacted by that. But basically what happened in summary is that there are, in the healthcare industry, there are two main, I will separate companies into main categories. The one that makes money, the one that promise money. Okay, so most of the small biotechs are just promising money. They are still not generating any revenue. They are burning a lot of cash because they need to develop their next generation drugs. And maybe one day they will do a few billions. Those set of companies have been heavily negatively affected by raising interest rates, because it will be raising capital will be a lot more difficult. The cash they have to run clinical trials may not be sufficient anymore.
Yeah.
The net present values calculation of something's very risky like biotechs is completely screwed up, and so on. So evaluations drops. On the other hand, healthcare like large pharma that get money consistently, and they could adjust their drugs prices matching inflation quite easily. Those has been seen as a safe haven for stock investors. So you have seen a valuation of pharma going up quite substantially. And I think we are reaching the inflection point, because now dividends of pharma are like getting quite low, historically speaking. So I don't see, I don't see much value anymore to keep buying pharma at this point, because sure, they are stable, but maybe there are better opportunities out there. For instance, money market, it's probably much better than investing in a pharma that pays 1.5% dividend. But it's very interesting, because most of the exit or outcome for small biotechs is usually they will be acquired by large pharma. And large pharma now has a lot of money to buy undervalued biotechs company. And that's happened recently. Pfizer announced the acquisitions of Seattle Genetics for $30 billion USD, which was one of my stocks that I had. So that was another things that drive my performance in Q1 2023, which has nothing to do with the interest rates. So even another example of how when macroeconomic is not really on your side, you can still make money if you pick the biotech stocks that also receive interest from large pharma, that's for instance.
Yeah. Okay, thanks, Simone. And I thought I'd very briefly just touch upon, it's not really a new news at the moment, but obviously China has begun its reopening after what obviously happened with COVID-19, and they were restricted for a lot longer. What's everybody's view on terms of demand increasing from China? And are people generally quite positive about Chinese stocks moving forward now that the demand has come back online, and as well as they are taking a slightly different stance in terms of quantitative easing against quantitative tightening that obviously US and Europe are doing? Zach, I know that you have some Chinese stocks in your portfolio, right?
Yeah, I do.
What's your views on China, and which sectors do you think might do well?
Yeah, China's an interesting one. Yeah, it's interesting because they haven't quite reopened like properly. I think I saw the stats is like they haven't finished renewing their passports. They don't have enough pilots who have their licenses renewed, stuff like that. And yeah, it just takes a while for them to come back online. So even though they said they've reopened, it just takes a while for them to come back out. So just be patient, and I think it will do well. Which sectors? I'm just buying the government ones because I think that's really undersold. I have a China Cement, which is fascinating. I think it's one of the stocks I'm going to cover later, so I'll leave it there. Stephen, I think you're the best person to answer where China is at, having stayed there.
Yeah, has been a while since I was living there, but yeah, I think you're right. I think it's going to take some time for the demand to ramp up. It's not like a button that you switch on and everything comes back online overnight. There's also some political issues that you got to bear in mind as well, with potentially what's happening in Taiwan. I do think it's less likely that there'll be an invasion on Taiwan. I think it's more likely to be an economic, what we're going to call it, an economic strangling to try and influence other countries to put pressure on Taiwan. But yeah, I'm generally pretty positive about the Chinese market. And I think mainly is because the government is very supportive of economic policy as well. And I think that they are starting to do a lot of quantitative easing. I think that they've reduced the reserve ratio requirements as well regularly over the last kind of year or so, whereas the rest of the world is doing the opposite, right? The rest of the world is increasing interest rates and restricting liquidity in the markets, whereas China is starting to open up. So yeah, I think it could be a good year for China. I also thought the end of last year would also be good for China, but those policies took a lot longer to fall into place. I think it's pretty positive as well about Alibaba splitting into those 6 different business units. And I think that is a real sign that obviously the government's had a lot of clampdowns last year on anti-monopolistic policies and companies. And I think a lot of them have reached agreements with the Chinese government about how they can and how they should do business moving forward. And I think that those split into different business units of Alibaba is part of that. And I think JD.com, I think, are also doing a similar thing as well. So as in China, everything comes from the government, and then the private companies then work out how they're going to fit around those demands. Hugo, you invested at all in China? Have you got any views on China?
Not anymore. I haven't been investing in China since probably 2 years ago, and I don't really plan on coming back. I think short term, I agree with your views. I think reopening is going to be slow, but you're starting to see sort of economic data picking up, activity picking up, natural resources bouncing a little bit, copper, for instance. And so I think the way I got exposure to that is through natural resources. I think you're going to see a few quarters of reasonable growth. But beyond that, I think I'm pretty negative on China. I think demographics are terrible. I think they're in a sort of long-term liquidity trap. And the whole geopolitics, the conflict with the West is just not really helpful, right? They're not getting access to semiconductors, or it's going to be expensive and difficult. Other critical technologies as well. It's just slowed down the development. And to me, they look a bit like Japan in the early 90s, except that they're starting from a much lower place. And obviously not even talking about the issues of do you really own China shares when you're a Western investor, and the sort of lack of rule of law, or the sort of like omnipotence of Xi and his close relatives. So I think there's a lot of issues investing into China, especially when you're a Western investor. Probably if you're closer to China, like you guys are, it's probably a little easier. But yeah, I think short term looks pretty decent. I think long term looks pretty difficult.
Yeah, there are.
It's okay. I'll convince you by the end of this call. That's my job.
You want to convince him now?
No, we can go later.
What about you, Rob?
Look, I'm I think China reopening, there's indirect ways that you can get exposure. If you look at Zim, 42% of their traffic goes through the Pacific Ocean coming off the coast of China over to the United States. There's many ways you can take advantage of China without actually owning Chinese equities. And I think one of the scariest things I would see as an investor in China, if I was invested in China, is Masa Son from SoftBank divesting from Alibaba. And the reason being is he's the eternal optimist on China, and now he virtually owns nothing in China. Mark Mobius was a big, massive cheerleader of China last year, and then he's crying wolf on CNBC because he can't get his money out of Shanghai because of capital controls. So just on what Hugo said, like I have no idea what I own. I don't even know if I have a claim on it because they're variable interest entities. And so there's many ways to play China. I'm not doubting that the economy can roar, but I think there's indirect ways that you can play, like Zim. It's obviously a company that's registered over in Israel, but that's a company that's going to be, and it's not an ADR problem. ADRs are just shares that are sitting in a bank vault at JP Morgan, and then there's shares issued on that, so you don't have the listing costs. So look, I think China reopening is obviously going to be reasonably bullish for global demand, like commodities, as Hugo said. I think shipping straight out of ports of China, straight into the United States, 42% the volume coming out through the Pacific Ocean for Zim. I think there's lots of ways to play it. But yeah, I generally agree that reopening the economy is going to be bullish. We might have differences of opinion on how to play that, but I think overall economically, probably we're on the same page.
Yeah, I think a lot of it's about portfolio weighting as well, and how much you potentially risk on the Chinese market, because there are risks involved. I'm also an investor in Zim as well. So yeah. Okay, cool. I wanted to ask as well about, there's a lot of stuff and there's a lot of talk, especially in the media right now, about the US dollar and the potential, if I was being alarmist, I'd say the potential for it to be knocked off its perch as the global reserve currency. Obviously, there's a lot of discussions at the moment. There's been a lot of deals between kind of China, Russia, Iran, and some other countries around using some of the national currencies in order to trade oil, natural gas, other such commodities. What are your views on the US dollar and either the future strength or the weakness? I'll probably start off with Zach, because I know that you have a very large trade in the US dollar over the Swiss currency. What are your views on the strength of the US dollar, and how are you playing that out in terms of your portfolio?
I just think we had this argument like for 60 years. This is not something brand new. I have no stats to back this up. I just don't know where else you're gonna go. What are you gonna use? Chinese yuan? You buy it. It's just ridiculous. You're gonna use the euro? Like the God's there, like Robert said. So what are we gonna do there? I'm not gonna use the euro. I'm not gonna use the yuan. What are you gonna use? There's nothing else. Like, where are you gonna go?
Yeah, we're certainly not going to use the ruble. Well, we're not going to use the ruble.
Yeah, so it's just a question, where are we gonna go? There's just nothing else to use. So yeah, sure, definitely US dollar will lose its dominance over a long period of time, sure. But it's not gonna happen tomorrow. It's gonna take a long time. So I think like slowly people are just gonna stop using US dollars so much, which makes a lot of sense. But yeah, I don't see it, man. I don't see it. Like, do you expect the euro to be 120 against US dollar? It's gonna mess up the balance of trade so bad. It's not gonna look funny at all. Yeah, they don't want a strong euro either. So where are you gonna go? I don't know.
Just on that point that Zach was saying, the US dollar, we have confidence, like as a European, I can do business with a Japanese and international market and use the US dollar. If you look at the BRIC nations and this total nonsense about them coming up with their common currency, outside of their relationship with China, there's nothing in common with those regions. So there's no real cross-border transactions. And then if you look at the buildup of renminbi that Russia have after selling them oil, they can't even use that in China, because if they could, they'd be using it for increasing cross-border trade, and instead they're liquidating whatever they can because they're in a deficit over the past year. And so not even and if you look at the latest agreement that the Russians and the Chinese had, they didn't even agree on the currency that they're going to use. And to Zek's point, there's not, money's a confidence game. There's nothing backing the US dollar other than the US Navy. That's it. And they're protecting the trade routes, or at least that's what they were doing. That might change. It might come somewhat multipolar where the Europeans build out an army. But as of right now, it's the US military protecting the trade routes. And that gives us confidence to use the US dollar to mediate a transaction from Europe to Japan. There's not a hope in hell I would use Chinese renminbi with an autocrat like Xi controlling everything for 1.2 or 1.4 billion, whatever the population's at. And so if you look, we're guaranteed to see a change in the currency. As a human, am I going to die? Abso-freaking-lutely. But when? I've no idea. And so if you look through history, like the British pound, the challenge we have today is the Brits had it easy because a colony of the United Kingdom was the United States. And the principles that were built up in the United Kingdom were also fairly representative in the United States. The problem is the United States has a more sort of democratic, no, it is a democratic system. And if you hand it off to an autocratic system, then the rules of the global trade are going to be set by an autocrat, and nobody really wants that. And so it's a much more difficult situation. I think we probably have another decade of the US dollar at least, but you're probably going to need to see a country like maybe India develop over the next 10 or 20 years, a democratic country that's big enough, that's going to grow enough that we can save in, let's say, as international institutions, we can save in their local currency and support their development, but that's going to take time. So I agree 100% with what Zek's saying is, what else do you use for right now? Quite happy to use US dollar. I don't really think it's going to go anywhere. I think it's slowly going to grind lower, but I don't see it materially disappearing like all of this nonsense that you're seeing.
I think in history, I think the global reserve currency's probably changed like every 100 years. But I also think it depends on probably, guess, two factors. One, the strength of the country. Obviously, US is strong, protected by the US military, etc. And also, I think a lot of it is about the stability of the government and how they implement monetary policy, etc., and whether they can be trusted from around the world. And I agree with you all. I think China's not there yet. Definitely not Russia, definitely not Iran. So you can't see it moving over in the short term. So do we think that this pullback in the US dollar is mainly to do with all of this media attention around it? Or do you think it's more to do with the potential of interest rates stop increasing and with reverting more to a mean? Because obviously the US dollar was really strong last year. Are we now reverting back to more normalized levels? Hugo, anything on that?
Yeah, in my view, it's mostly a divergence in monetary policies, right? The US started tightening quite a bit earlier than the euro, for instance, or obviously Japan that has never really tightened. And so that kind of that was one of the main drivers behind the rise in the dollar in 2021, 2022. As well as a stronger economy overall. And now I think other economies have caught up a little bit. Other central banks have also caught up on the tightening, while expectations for the US are for overall slower economy and lower rates. So I think that the sort of differential expectations has been one of the main drivers behind the fall of the dollar, as well as sentiment, to be honest. I think it is probably got a little more to go, but over the long term, I think similar to the other speakers on the panel, I think I'm very optimistic for the dollars, at least over a sort of like 10-year basis.
Yeah. And it depends, I guess, on the rate moves of the major banks around the world, what the EU do, also what Japan, China, other countries do as well in terms of monetary policy. I'm going to move on now to Bitcoin. We're going to be talking a little bit about the rally that's happened so far in 2023. I think Bitcoin's up over, I think it's about 85% up for the year so far in 2023. It's performed really well, but it has to be said that was on the back of a really, really tough year in 2022, where Bitcoin drew down pretty significantly, pretty close to 80%. So I wanted to get the panel's views on Bitcoin kind of moving forward. And I guess the subject that I wanted to talk about is, do we think that Bitcoin will start to outperform mainly because of the bank crisis that's in place at the moment and people considering Bitcoin more as a store of value because they don't trust their money in banks. As we said earlier with 𝗥, a lot of people are moving their money over to funds and to bonds, etc. But are people starting to allocate a certain portion to Bitcoin now because of obviously it being decentralized and having control of your own money and your own private keys? Or is there more to this rally, liquidity or other areas? To start off with you, Rob, what are your views on the performance of Bitcoin so far and the way you see it as a play?
Yeah, so I wasn't that surprised to see how weak Bitcoin got, because I guess I was more surprised to see how high interest rates went, given where the leverage in the US government's balance sheet has come from 2020. I think I was more surprised to see how high interest rates actually got. But given how high interest rates got, I'm not as surprised to see how low Bitcoin got for that reason. I think Bitcoin is just a liquidity phenomenon. And if you mapped the year-on-year rate of change of Bitcoin to global M2, it's the same chart. Yeah. And so where we are as of right now, like just to add to the view on the dollar weakening, I think part of that has to do with dollar swap lines opening up as well, which happened in 2020, helped ease the availability of dollars. Remember, currency works in supply demand as well. So the euro dollar market, like euro, is obviously international when we're talking about these things. Like the international dollar market, let's call it that, was very tight, opening swap lines, providing US dollars. You have this easing liquidity internationally, as well as at the government's balance sheet. TGA, the Treasury General account, is drawing down. Like liquidity is moving into the market. As you mentioned, Stephen, you've seen the Fed's balance sheet increase 400 billion in 2 weeks after the regional banks had a funding crisis. And so you have all of these different variables coming together to drive the price of Bitcoin, I think, in the near term. But longer term, I think it is like a catch-22. The CBO, the Committee for Budgetary Office, I think it's the Committee of Budgetary Office or whatever you call it, I'm not sure. Yeah. They're forecasting a $1.5 trillion deficit for the next 75 years. And that's based on obviously the amount of taxes they'll generate, the expected military funding, interest expense, all that sort of stuff. $1.5 trillion every single year. Like, where does that come from? So if you go back to the Federal Reserve, its function in the first place, after the 1907 banking crisis, it was JP Morgan's son-in-law, Senator Ulrich. JP Morgan approached Senator Ulrich, and then he proposed this new institution called the Federal Reserve, Jekyll Island, 1913, and then the Federal Reserve started in 1914. Its primary function was to provide liquidity during times of crisis. So with the geopolitical rise, the only way the US government could cut back the discretionary spend is get rid of that military budget, which is like 850 billion. I don't see it happening at all. Interest expense was forecasted for $650 billion this year. It was 850 in Q4 last year. And so what I'm trying to say is you've got a big deficit that's not going to stop. Who's going to finance that? And so my view is, sure, the Fed can talk tough, and sure, we might go through this cyclical period of weakness, but long term, there's a structural problem with the amount of leverage on the government's balance sheet. I don't see anyone capable of financing that other than the Federal Reserve, which means liquidity will have to continue expanding net for quite some time. So bigger picture, I think Bitcoin is ultimately going to be a fair reflection of the amount of liquidity that's created. And I think in the near term, that's been the initial move since, I think, last December or November, something like that. That's what my view is anyway. I think it's a really dumb, easy to understand asset. And if you get the directional bias of liquidity, I think you get Bitcoin right.
Yeah. I'm glad you said that, Rob, actually, because a lot of people have said to me, oh, Bitcoin failed last year, right? Because the markets went down. It was supposed to be a store of value and the market went down. It clearly isn't a store of value, but completely correct. And all of the data actually backs that up, that it is actually following global M2 being obviously put into the market, as we saw in 2020 and 2021 when they were printing more and more money. Bitcoin went up very significantly. And as they shrunk their balance sheet last year, Bitcoin went down considerably as well. So I think it's an important point to note that people consider a store of value properties as being very different to what they actually are in reality. Yeah. And also we have the halving coming up as well next year in 2024, I think it's in April. And that should cause some type of supply shock like it has done in previous cycles.
Yeah, I think from here though, because the rewards from each block is gotten to a point where it's far smaller after a couple of halvings, I think from here, like the biggest variable is going to be demand increases. More and more people starting to maybe like look at it as a vehicle for saving for long, like holding capital or holding wealth, a vehicle for holding wealth over long periods of time. That's how I look at it. And I think is the reason why, this is quite ironic, but the reason why I got interested in Bitcoin was because Cyprus got bailed in 2012. And the irony is just a couple of weeks ago, there's a lot of people that are obviously very uneducated on how the financial system works, decided that it would be a good idea to bail in Silicon Valley deposits when their assets just needed to run off. There was nothing wrong with the credit quality. But we're talking about a US bank, bailing in a US bank. I'm like, of course I'd rather own Bitcoin, as you said, on a USB key, where there's no overreaching hand from the government. And over time, it's inflationary in the sense where the price will appreciate because the supply depreciates and so on.
Yeah, and it makes sense that Bitcoin outperformed most of the altcoins within that period. The Bitcoin dominance increased as well because of the fact that people were converting to Bitcoin from their banks as a kind of long-term storage way instead of speculating. Zach, I wanted to talk to you about this point as well, because I know that you work in the crypto industry. What are you hearing and seeing on the ground about what's happening and what people have views and large institutional investors, etc.? What are your views on the Bitcoin crypto market?
Regulation is hard. People haven't come back into Ethereum or DeFi or anything like that, so there's no leverage in the system. I don't know. It's not positive. I hear all the arguments for it, and I agree with Robert. I would keep Bitcoin purely for those reasons, and I do. But other than that, I don't see this rally going much higher other than sentiment or liquidity. It's just become so difficult to buy Bitcoin.
Yeah.
Steven, you have way more crypto than me.
Yeah.
You should go. You should.
Yeah, I think, yeah, it's quite interesting to see that Zach's now become a Bitcoin maximalist, because like maybe a year or two ago, it was completely different, right?
Yes, yeah. I said I don't, it's like gold, like Warren Buffett and gold, right? It doesn't do anything on my bother, but now I can't even touch Ethereum. I'm just going to Bitcoin.
Yeah. One of the issues at the moment is in terms of being able to onboard and offboard fiat money and be able to put money into the crypto ecosystem. A lot of obviously in the US, there's lots of regulations around it. And there's this kind of operation choke point, which is really trying to stop money going into exchanges in the US and other areas in the crypto ecosystem to make it a bit more difficult. So it's quite hard at the moment to onboard fiat money into the crypto ecosystem. There's still a lot of ways to do it, but that might make it a lot more difficult in the future for retail participants to be involved. I know a lot of European banks are also restricting this at the moment as well, but I generally think that regulation is going to be really important, especially in the US, to have some regulatory clarity around it. I think that there'll be a lot of institutions and treasuries that will want to allocate to Bitcoin, especially not the altcoins, but Bitcoin in general. But I think that they need a lot more clarity in terms of accounting practices and how it's actually put into their balance sheets, etc. And also, I think regulations about how they can hold it, how they can custody it, etc. So yeah, it's going to be an interesting time.
Yeah, I think there's a potential catalyst coming. I think I kind of share Rob's view that Bitcoin has been mostly a play on liquidity since it was created. I think if you do a regression, you'd find that Bitcoin is 80% Q and 20% gold over time, which are really both plays on liquidity. But then you get those sort of oh shit moments where I think Bitcoin just shifts more and more towards being a sort of digital gold store of value. It's not really quite there yet, but obviously you had the Cyprus bail-in.
Yep.
Recently, you had a sort of confiscation of Russian reserves. by the US and allies. It also tells you that the dollar might not be a safe place for everyone. Obviously, banking crisis in the US, and then you have obviously the sort of like budgetary situation of the US, of Europe, the over leverage of the Chinese economy. And all of that tells you probably something over the next 5 to 10 years, something's going to break somewhere pretty badly. And so you've got those sort of like moments in the economy where you just look at Bitcoin as a potential solution to a whole lot of problems. And I think that's going to continue to happen. And I think each of those catalysts will slowly but surely put Bitcoin at the forefront of people's minds when it comes to protecting value.
Yeah.
You have the sort of, I think it's Grayscale versus US government lawsuit now trying to get a Bitcoin ETF. I think the legal position looks pretty strong. So if you start getting a Bitcoin ETF, that is potentially a catalyst for institutional adoption, which I don't think is really needed right now, but it's still a positive over the long term. So I'm a mix of Rob and Zach, to be honest. I think I'm becoming more and more of a Bitcoin maxi. I think it's driven by liquidity, but if you look into the future, I think there's going to be times where it starts decoupling from liquidity and just gets the kind of bumps that it's been getting this year, where liquidity improves at the margin, but Bitcoin is at 50%. Why? I think there's liquidity, but there's also something else going on.
Yeah. Yeah, I agree with you, Hugo. I think not only is Bitcoin kind of being seen as a store of value, but I think it's also been seen as a form of insurance, something that you want to have there in case something happens in a particular country, something happens with the banking system. There's a whole host of reasons, but I think a lot of individuals plus institutions will eventually want to have that insurance as well in their portfolios. But there is certainly going to be a lot of volatility. That is something I can tell you. Simone, before we move on to the next subject, what are your views on Bitcoin in the crypto market?
I think you touched most of the points. What I want to put a bit more emphasis, maybe it's on the regulatory crackdown that was going on over the past 8 months or 1 year or so, especially in the US with the SEC. I think we need more clarity, especially on what is not a security. So for Bitcoin, it looks quite clear that it's not a security. She might have different idea. We don't know exactly. But once we will have more clarity for the other coins, there can be a bit of movement. So
yeah,
we might increase Bitcoin dominance over other coins if the other coins will be deemed as security from SEC. Because then, and the other thing is because of all these exchanges that are going busted, people are moving their Bitcoins into wallets, their own wallets, which make it difficult to trade because you need to move it back to the exchange if you want to trade them. But that will increase the narrative of Bitcoin become a store of value, because once it's in your wallet, you're not gonna move it. You're not going to sell it for a while.
Yeah, that's a very good point. And I think it's something that we didn't talk about when we were talking about crypto, is that I think another factor, the reason why it's risen so much in 2023 is that most of the speculators are already out of the market, or the weakest hands had already sold. And people that believed in Bitcoin for the long term had set a floor or had set a bottom in the price of Bitcoin and have been accumulating ever since.
Very quickly. Yeah, I think all of us should consider adding Doge because of this partnership between Twitter and eToro. Such a big deal. It may become the new store of value. You guys should think about it. Let's all buy Doge.
Store of value for dogs.
Dogecoin, man. Dogecoin. Let's go for it.
I might leave you to that one by yourself, Zach, if you don't mind. Cool. All right, so we got a fun segment to finish everything off. I've asked the panelists to prepare 3 different things. One stock that they would like in their portfolio that they would potentially like to add to and why, as well as a position in their portfolio that they're happy with their allocation and they're going to hold it as it is. And lastly, a position, if obviously everybody has positions in their portfolio that they believe in, but if I put a gun to the head of every one of these popular investors and you had to eliminate one stock from your portfolio, which stock would you eliminate and why? I'll get started with Zach. Do you want to go ahead?
Sure. I'm going to start convincing people. Hang on. Okay, so my stock to add, yes, my stock to add is going to be China Building Material. I think that's the one. So it's 3323.HK. So this is a cement, the biggest cement provider in China. And it's giving a dividend yield of something like 7% or something like that. I can't remember the exact numbers, but it's giving a dividend yield. So it's pretty decent. Right? And if you think about it, stimulus is coming to China. And they had really bad earnings because they're coming out of the COVID lockdown. So that's another tailwind factor that you can think about. So that's why it's cheap. So you got dividend yield even though the market was bad, and you have like positive catalyst, which is increasing stimulus, spending and all that. So to me, it's very hard to lose on this trade. If I'm wrong and earnings stay the same, which is rubbish, the same as whatever closed COVID demand that they used back then, it's going to stay about the same. You still get a 7% dividend yield, which is fantastic. If I'm right and all this stimulus comes into the economy, then it's going to take off. You're going to get higher dividend yield. All the stock price increases, both fantastic. Stock to eliminate, I am going to sell my Shiba and I'm going to buy Doge, just like everyone here. We're all buying Doge. Stock to hold, average, because I think it's interesting, but it's underwater by 40%. So we'll see how it goes. But I'm happy with the allocation. Okay, let's move on.
Okay, from Bitcoin maximalist to Doge maximalist. I present to you fund manager Beck.
All of us are going to be.
Yep. Over to you, Rob. Do you want to go through your 3 stocks?
So the stock that I want to add to first, Lumentum. I've already built a decent chunk in this, but they sell, it's non-discretionary, it's B2B2C. They sell components to, for argument's sake, Sina, and then Sina will put it into their products and then sell it on to maybe AT&T or whatever for fiber optics and stuff like that. And this is a company where the industry has overbuilt its inventories. So Sina's cutting back because their inventory has gone from 400 million up to 1.1 billion, but their backlog's gone from 1.3 billion up to 4.2 billion. And if you look at Charter Communications, for arguments, the segments that's going to impact specifically Lumentum have actually increased by about 20% year on year. And so you've got a weird scenario where you got inventory, we have to burn through this inventory, but demand is pretty solid. Orders have slowed down and the stock price is being hit. They were supposed to go out and buy a company a few years ago, and that deal fell through. So they raised 220 million for the break of the merger, and they ended up essentially raising loads of debt, and it was convertible bonds. 0.5% is on the 2028, 2026 converting bonds, and it was 0.25 on 2024, which matures actually in December this year. But they have that in money market funds collecting as much as 4% right now. So they got 220 million for the break of the merger. They use that to buy back stock. They're collecting net interest income because ultimately they're operating as the best bank in the world, borrowing at 0.5% and essentially investing at 4%. And the stock price is dropping because of really insignificant stuff like losing some revenue on the iPhone 15 for VCSELs. That's only 12% of the revenue, that entire category. So the impact on the revenue, in my view, is way overstated. The share price just continues to drop. But if you can look past the next 6 months, it's a really attractive business. The one that I want to hold is, I just finished building it out. It's Baxter International, done a botch deal on Hillram. There's a sort of trend here. I like to buy the stuff that nobody else wants to own, the sort of dog shit that people perceive it to be. But Baxter is a reasonably solid business. They've got a really wide diversified business, selling everything. They've got one little company called, for argument's sake, Celebrity Pharmaceutical. It's a small business. They sell like lip fillers and injectables and all that sort of stuff. And on the other side, you have stuff like IVs, and so they've got pharmaceuticals, all these different divisions. But the structure of their business is really interesting because the revenue is on longer term contracts. The backlog's 10.7 billion. That's spread out into 2027, but 65% of that's coming due into 2024. What's the problem? You have fixed rate revenue and you're buying your raw materials on the spot market. So their costs start to increase quite a lot on this fixed rate revenue. Share price drops lower, margin drops lower. Net income negative 2.2 billion. That was actually an impairment on the Hill-Rom acquisition. They recognized 2.8 billion of the goodwill. So that's a non-cash expense, but people are worried about its income. But if you add that back, they had a 12% operating margin. They had a 39% gross margin. Yeah, there's some moderation because of labor, sure, but there was some moderation because of inflation. But you're going to start to see the tailwinds of that play out over the next 2 years. So I built out a reasonably sized position, pretty excited about it. I could actually probably add more to that, but we'll leave it as one that I want to hold because it's my second largest position. And then one that I want to eliminate, I'm just going to go with the one that I'm probably going to sell next. And it's not one that I dislike, but everything's for sale at a price. Yep. And it's Crocs. Wonderful business, an incredible business. But the way in which I look at its valuation is I would determine its terminal value looking at the average of a perpetual growth rate model and the multiple of enterprise value to EBITDA, and I get the average. And with perpetual growth rate, I'd be using like, assuming that cash flows grow in perpetuity at 1%, the valuation would come in at about, I think it's 8.9 billion. And as of right now, I think we're at 10 billion. We're a little bit overvalued relative to that terminal value. We're way undervalued relative to enterprise value to EBITDA. But from here, it's just a bet on multiple expansion. So I'm looking at Crocs and I've already reduced it significantly. It used to be the biggest position in the portfolio. I've already cut it back massively, but it's probably going to be on the chopping block soon. So there are the three companies anyway.
Perfect. Thank you. Thank you, Rob. Hugo, do you want to run over your three stocks?
Sure, let's go for it. The one I would really add to is 𝗲𝗂, which has been my top position for a long time and got whacked a little bit recently following the banking crisis. 𝗲𝗂 is a distributor, supplier of electrical equipment to a pretty wide array of consumers. Think about data centers, think offices and commercial buildings, safety, security, equipment as well, vehicle charging stations, solar system installations. And so they distribute essentially everything that's behind the sort of trend of electrification that you have in the US. And that's been going really well for them over the last few years, as obviously the US tries to catch up because they're very late in terms of electrification versus other countries. And so there's a whole lot of private investment into electrical infrastructure, as well as public investments. And now you're going to start seeing pretty soon the sort of like CHIP Acts building semiconductor factories across the US. You're seeing a lot of investment into residential as well as utility scale solar farms, obviously vehicles. So there's a lot of various subsectors within the electrification trend in the US that are really interesting. And obviously artificial intelligence is going to boost the whole data center subsector as well. So I think if you look at those like verticals where 𝗲𝗂 are active, i.e. data centers, EVs, solar farms, they're all booming, right? And yet the stock is valued at 7.5 times earnings, which is 3 times below the 10-year average. My view is essentially the stock is going to continue to grow by double digits. And so you get the benefit of that. And then you have multiple re-rating when people realize that thing keeps growing. Instead of being valued 3 times below average, it should probably be valued 3 times above average. So it got waxed because of the banking crisis on the back of people expecting that tighter financing will mean less projects going on, which is potentially a fair assumption in short term. But then if you take a long-term view and you look at the sort of like investment that is being made into electrification, plus the CHIPS Act, plus the sort of Inflation Reduction Acts, there's just trillions of dollars that are going to flow into those sectors. And that are still not reflected in the financials. I think it's a pretty golden opportunity that you have there for 7.5 times earnings, around 10% cash flow yield. I think it's super attractive. So that's the one I would add to. The one I would keep as is probably the investments that I have in the residential housing sector. I have Taylor Morrison, I have Builders FirstSource. I've been super bullish on them for 2 or 3 years. Felt pretty alone against the whole world, telling us that we're going to have the housing crash. Guess what? No housing crash. And those stocks are up 50% of the summer 22 lows. And so these are sectors with very strong fundamentals. The US has underbuilt for 15 years. Demographic is pretty positive. You just want homes, and there are no homes available. The stocks are still valued pretty cheaply, reasonably below average. And now you're seeing that in a sort of downturn, quote unquote, within the industry, those companies continue to perform very well because there's no other supply. It's just home builders. If you want to get a home, you buy a new home because there's almost no existing home for sale. There's no stock, there's no inventory, nothing. And so the demographic trend is going to continue to be positive in the US, right? Population growth, millennials coming of age and wanting homes. And the supply is just not there. It's not there, and it's not going to get there because it's expensive and complicated to buy a home because the cost of funding, thanks to the Fed, is really high. And so you have just an environment where long-term demand is going to be really strong. Supply is constrained by a whole lot of building regulations and financing. So it's going to continue to do well. Now we're in a 𝗏. Companies are still doing well. If we get out of that 𝗏, then it could be fireworks. Valuations have caught up quite a bit. That's why I would probably not add to them, but the outlook still looks pretty decent.
And eliminate.
Yeah, I have a position in precious metals that I don't particularly like. It's like Zach said, having gold is a bit stupid. It does nothing for me, especially when it's in a vault somewhere in Switzerland. Like if the liquidity upturn back in October, and then when the sort of narrative of higher for longer rates won in January and February because employment was super strong and CPI came hotter than expected, I thought that was a bit bollocks. So I bought a bit more gold and silver. I can't say I saw the sort of banking crisis coming, but I just thought that the sort of higher for longer rates was just stupid. And so I bought more gold and silver and Bitcoin as well. It has done very well for me. I'm up 30-something% on my precious metals position, which is great for a 4 to 6 month hold, but I don't like it. If everything was great in the world, I wouldn't own precious metals. That would be a sign that everything is functioning properly. There's no problem in the financial system and stuff. So
that's your insurance. That's your insurance.
Exactly. You hate having to buy insurance, but
sometimes you need to use it. Yeah, understand. Okay, thanks, Hugo. That's really insightful. And Moni, you want to go over your 3 stocks?
Yes. Okay. As you expect, I'm gonna pick 3 biotech stocks. One to 𝗏, one to hold, and one to eliminate.
And go with what you know.
Okay. The one to 𝗏 is Seattle Genetics. I talked about this before. Pfizer announced their acquisition of Seattle Genetics a few months ago for a price of $229 per share. Currently, it's trading at $205, more or less, which means there is a more than 10% upside potential that will happen if the acquisitions will be completed. And the risk of the acquisitions being completed have very little to do with earnings or the interest rates or macroeconomic conditions, which is a great way to diversify the portfolio. So it's a nice part of the portfolio that will perform independently from the majority of stocks that I have. And historically, the chance that the acquisitions won't happen, I will say it's quite low. So it's a low risk, 10% return. I think it's pretty good there. Stocks to hold. It's a small biotech. It's a bridge bio. Currently has a market cap of 1 or 2 billion, I think 2 billion USD. They recently had a very good phase 2 clinical trials for a rare disease, and the stock price jumped 150% since I bought it. So that's why I don't want to add it. But there are rumors of acquisitions, and also in August they are expected to have another clinical trials readout, which will move stock price. There is high risk, so that's why I don't want to add it, but there is potential return for that stock. And also that one has very little to do. It can be affected by interest rates, but then they perform the readouts of the clinical trial. It's what is going to matter the most.
Okay, and I'm going to hand you over the axe now, so you can axe one of your stocks.
Actually, eliminated just yesterday, so I don't know if that counts.
It counts.
But okay, I removed Merck, which is one of the stocks I was saying to add in the previous course that when you were asking me similar questions. So Merck has been doing very well so far, and maybe can still do well over the next few months. but its leading drugs that is generating 20 billions per year or so is set to expire the patent by 2027, which means it will create a hole of 20 billion in Merck's revenue that it needs to replace somehow. And the way it's going to replace it is through acquisitions. And if it's going to buy, let's say, 2 or 3 biotech stocks to replace $20 billion revenue, that will affect stock price a lot. So I think stock price of Merck will drop significantly. And on the top of that, if interest rates will start dropping, people will move away from healthcare, big pharma stocks. So very risky to stay in that stocks right now.
Okay, thank you, Simone. And I'll end it by going over my 3 different stocks. So the first one I want to add to is Comstock Resources. And this is a natural gas producer. I'm quite bullish about natural gas over the next kind of 12 to 18 months. Obviously, natural gas price has reduced pretty significantly, and it's a position that I got into fairly recently, so near the lows of the natural gas prices so far. But I really like this company. One is because it's one of the lowest cost producers in the United States of natural gas. So it has one of the lowest costs. It also has an extremely low valuation. So we have I think it has a PE ratio of about 2.7, if I'm correct. So I think it's very undervalued. And I think there's a lot of expectations that the natural gas can increase and can bounce off some of these lows. And I think that natural gas got impacted quite a lot by weather conditions, slightly warmer than expected weather conditions in the winter. And obviously with what happened with Russia, etc., and there was more of a supply of natural gas coming from the US as they tried to pick up the demand. And I think that this stock is quite well placed to perform well this year. There's also been a lot of insider buying by the top executives in recent times, and by the CEO, by the CFO, etc. And I think that this stock will perform well. I have a starter position in this stock, but I plan to increase that significantly over the next few weeks as it's still at a very low valuation. Second stock that I wanted to talk about, and it's just a stock that I will hold, and that is a stock called Sinclair Broadcasting Group. And that's a stock that I actually put into my portfolio about 6 weeks ago or so. And it's a stock that got beaten down pretty significantly in 2022. It's a broadcasting group, and there was a lot of expectations about lower rising spend, etc., as we moved into a recession. And there were some other issues as well. And it got to a point again where it was a very low valuation as well. I think as we get a lot closer to the election, the US election, I think that spending of advertisement could increase. And I expect this stock to do well. I'm not going to add to it any further because it has gone up about 30% over the last month or so, but I will continue to hold that stock as well. Third stock, the one that I would eliminate, is actually just a really boring stock in my portfolio called Hormel Foods. And Hormel Foods is the maker of a brand that we joke about in Europe, but it's more of a delicacy in Asia, and that is Spam. And they produce Spam, and the reason why I put it into my portfolio was that during kind of COVID, there was a lot of people eating from home, and they wanted foods that could last a lot longer and didn't need to be very well preserved, etc., as people weren't going out to the supermarkets as much, etc. However, they had a lot of stagnation and not much growth and not much, not much new brands, etc. And I think it's probably time to leave my portfolio nicely it's at about break even at the moment. So I probably will eliminate it, but it was a very small position in my portfolio. So those were my 3 stocks. So I think we will end it there. And I really want to thank all of the participants for taking part in this call. I had a lot of fun. Thank you for talking over and providing your expertise for the panel. And I'm sure the audience will really enjoy it. So thank you very much for your time, everybody.
Thank you.
Cheers.